This is the third video in our series about core option trading strategies. This one's entitled Back to the Basics. Normally, this would have been the first of the series, and I changed that this year around because of the strange circumstances under which this material is being offered this semester. And I wanted to use an actual example from Strangles so we could see by example how some of these strategies work. So I decided to set up the first two based upon the Netflix strangle and our evaluation of it. And then this one, which would normally be first, is now being offered. This is probably the most important lecture that I've given this semester, except perhaps for the first one or two. I have the same photo shot here in this one that I had in part two because I forgot to talk about it a little bit. This is a picture I took of my office in Parsons just before we all had to evacuate, and I'm a bit sad that I'll have to end my career here without ever being in that office again and working. I really liked working in that office. I would often get there on some days as early as 6 o'clock in the morning and pull up those two monitors and bring up the stocks on interactive brokers and begin my day's work. It's a comfortable place to work. And we had to get out of there in a hurry. And by the time this is all said and done, I will be retired. So I'll have some fond memories of the office. I wished I could have capped off my career by having my last day there instead of sitting here at my desk. This lecture, by the way, will be the last of the lectures for which you'll be accountable for the remaining quiz. I intend to give you more lectures past the time that we take that quiz or schedule that quiz, and even past the time that we turn your grades in. Because, of course, I need to catch up to some extent with material that I promised you. So let's just get through this, and then I'll send you an audio message about how we plan to cap off the semester. Okay, here are some key questions that you should be asking yourself now about options trading. How do you know when to make an options trade long or short? Is there a time to buy options despite time decay? Is there a time to write options, for example? How do you judge the degree of risk associated with an options trade? Are certain types of options trades always advisable in all markets or almost all markets? Are there some trades that you can do at all times and be profitable? I'll just answer that right now, even though that message is often preached online. The answer is no to that question, but we'll explore that in more depth in this lecture. And finally, what would Mr. Spock say about all of this? We have to go back to the logic that we started with. Mr. Spock, of course, would start by saying fascinating, because he always said that. And then Mr. Spock would insist that we apply logic to arrive at an answer. And that's the reason we're going back to our basics. So these are the questions we're going to entertain in this lecture, and we're going to go about this very systematically. Now, let's go back to our roots by using one of our Netflix options. I like to give examples that are based upon real trades, or at least trades that are being considered. I do not like to give abstract and academic examples. This was our original proposal on the call part of the strangle that we considered doing. You may recall this was in lecture 2. And so this was the Netflix April 24 call. It had 9 days to go, and it was the 435. And so this was our mapping of the expiry values that would be achieved given the price of Netflix after the expiry. We introduced that and criticized it some time ago. And so it was half of the strangle that I wanted to do for Netflix earnings that were to be on end of day Tuesday, April 21st, and that has now since passed. Netflix actually had a good earnings report, but we decided not to take the strangle trade because it was too expensive. And good thing we didn't. We would have lost a lot of money in doing it. But as we considered it, this was the April 24, 2020 expiry. Netflix out of the money 435 call, priced at $25.67 on April 15th, when Netflix was $432.31. Now that was the mapping that we had in the actual lecture itself. Then on Friday, you may recall that we actually selected a different set of calls and puts, actually the same call but a different put, because we went in with our strangle model and asked it to identify the most suitable call and put, because we were going to go into the strangle on that day if we were going to do it, and it selected the same call, the 435, but it selected a 430 put instead of the 425 put. And then we calculated the implied daily volatility for the call and the put and saw that they were quite high. Now we were considering two different expiries. We were considering the April 24th, the 7-day expiry, because earnings were to be next Tuesday, and this option on the top would be, these options I should say, would be expiring on that Friday. And then we're also going to map, and we are mapping still, the long-term expiry options that are due to expire on the next monthly, which is May the 15th, and at that time it was 28 days away. But of course the one we were going to trade was the one on the top. But when we took a look at the implied volatility and we compared it to the 30-day historical volatility, and then figured out where these prices would have to go for us to even break even, you may recall, we decided not to trade. The options were too expensive. But given that these were the options here that we were going to trade, I've modified the payoff schedules a little bit to reflect those options, because those are the ones we're going to use by example in this lecture. So now we're talking about the Netflix 435 with only 7 days remaining, and this was to be done on that Friday, and this was a little bit different. It was 2 days later. It was the same call. This time, though, it was priced at $17.90 only because Netflix had come down in value some on that time, or at that moment actually, to $415.58. And we were still assuming that the appropriate historical sigma to be used was the value of 0.04813, which we obtained by using our HVIEX model, using data from IEX Cloud. So this was actually the option ultimately that we were going to trade or not trade. And again, this is the one we decided against trading. And that's the one we're going to use for our model. So let's take this option back to some of the original assumptions that we made in this class in the first few weeks and apply some of the methods we used at that time. Let's go back to the core math effectively of this. So here we have, we ask ourselves, what do we remember about what we initially assumed and solved with our early models? And this is now a mapping of that. And we said we assumed geometric Brownian motion and compliance with the Wiener process. And that allowed us to normalize the Gaussian distribution of log growth rates to a standard normal distribution as shown here. And I think that was the very first model we tried to apply. And given that, we were able to reach conclusions about the probability of this stock being in the money. That allowed us in turn to calculate the probability of being in the money at expiry. And when our daily sigma is 0.04813, which we have assumed, although this distribution here reflects the duration volatility of 7 days, then we were able to calculate, with a slight modification of the Gaussian model, the probability of being in the money at about 33%, or would have calculated that if this were the problem we were trying to solve. In this presentation and the other distributions we have here, we're going to assume drift to be 0 because it makes it a lot easier to make this presentation. Our models do allow, as you may remember, for non-zero drift. But we're going to, for the sake of making these mappings understanding, we're going to assume 0 drift. And besides, that's what we would normally assume anyway. We were talking about, at the most, a 5-day options trade. And drift isn't going to matter in a period as short as that. So Also, though, what else did we remember about what we initially assumed and solved with our early models? Now, look at the abscissa and ordinate and compare those to the standard normal graph that I just showed you. Here, we are obviously not normalizing to a standard normal. We knew we didn't need to do that. We can calculate the same probabilities with a centered normal distribution, which we're doing here. And so, of course, we are not normalizing to one standard deviation and two standard deviations to calculate that. We're just simply accepting the distribution of this based upon its sigma and making the same calculation and getting the same result, that this probability that we might have traded but did not had a 33% probability of being in the money. Now, by the way, as a footnote, going into that actual trade, we did not regard the probability of that option going into the money because that was an earnings strangle. And we were hoping for a kurtosis event that would give us a 3 or 4 or 5 sigma result in reaction to earnings, which would have made that strangle valuable. So this, of course, is the normal assumption on a normal day of the likelihood of going into that. So this was the probability of getting into the money without that kurtosis event happening, more or less theoretically. And what else to remember about what we initially assumed and that I solved? I don't think I gave you this solution with our early models. The software program that I wrote to actually do this lecture, which allows you to enter values of real options and get these mappings, I'm going to post up for you to use. One of the reasons I'm doing that is because if you say, I want to try to simply integrate these functions and solve these problems this way, it is reasonably easy to figure out how to do that by taking a look at how these mappings were done in these models. Besides, you might want to play around with it a little bit anyway. So take a look again at the abscissa and the ordinate and compare them to the normal graph. And so here you look and you say, oh, we're actually mapping the stock prices down here. And so this does not look like it is symmetric on both sides, and it's not. So of course what we're looking at here is the transformed log normal distribution of the actual stock prices based upon the assumption of zero drift. And again, the daily standard deviation of 0.04813. Now you have to realize that had we used the standard deviation for 1 year, then this means of dispersion being shown here would be a lot narrower than it is on this graph. Also, when we look at this, we can see the strike price being represented, and we can see the stock price that is at the median. Actually, that's how you do this kind of mapping, at 415.58. So we know that we can transform this back to a mapping of a stock price, which is what we have here, which gives us this log normal distribution. This is calculated from the stock price median in this context of 415.58. Now, I didn't show you how I did this in the class. In fact, I was using an older mapping from an older lecture at the beginning of the semester, and I decided to bring that model up to date so that we could put in any current value for that and get a decent mapping out, which is why it's easy for me to make up these examples based upon real trades. So this is what it looks like in part. What I'm going to give to you is what I've added here that hasn't really been tested completely, which is why it was not in the financial utility methods set that I gave you last time. If we take a look at this, we've got a log normal distribution that accepts a single value for x, mu, and sigma and returns a scalar solution for the probability density function. In other words, it returns the maximum likelihood estimator, or the point on the PDF line, which is the blue line here. And then we have, as we did for the standard normal and for the normal, we have the distribution vector that can be used, for example, with a lambda function, which gives us an array that allows us to map out the entire probability function, or probability PDF. And then also we actually have a calculator down here that I have not tested very much that actually allows us to integrate this using SciPy's integrate.quad. And so these are the methods that I'm using to get these mappings out to show you. And if you take a look at these, it doesn't involve very much work. It involves some work to figure out how to simply integrate these directly with the integrate.quad feature of SciPy within Python. So that's how we got this mapping. Oh, and then there was this conversion, the second part of this. You need to look at this carefully on how I did this. It's not easy to figure out how to do this because when you look at Wikipedia and it tells you that if you have some x that is assumed to be a normal distribution, the natural log of x has a log normal distribution. I mean, the exponential x has a log normal distribution. We're not actually converting an x. We're converting a ratio, and that complicates the math just a little bit. But also, we, in our exponent, are multiplying it times a constant, and that actually makes it considerably more complicated. And I'll show you the math for that in a separate video, a separate slide, that was actually figured out by one of the students in this class about 5 years ago when he took a course somewhere in stochastic calculus. So it's a little bit involved actually to integrate this, but nonetheless, if you're good at math, you can probably figure out how to do it without any input from me. Okay, let's ask ourselves why it is we're looking at these mappings again. We basically started this semester with these in about the second or third week. Well, let's ask this question. If we were to integrate this probability density function, and this is the first one I showed you, from -4 to +4, what value would we get? And we didn't integrate it, of course. We used effectively a Taylor series expansion to approximate the integration. You may not have realized you were doing that, but it built into the library that does that. It is a Taylor series expansion. And the answer, of course, is 1 because of what this is. So that's not very interesting. And how did we get this probability of being in the money? From the perspective of simply the graph or the math of it. We made calculations and the like, but what effectively we were doing. And we integrated kind of, like I say, we didn't really use an integrator, but we used a substitute for it, which again is a Taylor series expansion working off of an error function, a well-known formula, up to the black line. And then we subtracted that from 1. But I actually have an integrator that works very well, the quad.integrate function that you have. It's in the financial utility. Will do this easily. You can integrate right up to the black line using that as a standard integrator, and it'll give you exactly the same answer as your CDSN or your CDF library choices you use to get the solution for this. So we're always going to say that effectively we're solving these values by integrating up to some point and either accepting that as the answer or subtracting that from 1. That's also, of course, true of the Black-Scholes-Merton model, but that's not what we're talking about now. We're talking about ours. Here's an interesting question. If we were to integrate this PDF from 340 to 490, take a look at the axes, what value would we get? And what exactly is it we're looking at here? Well, if you look very closely, this is 1 day where we're using sigma as itself instead of duration volatility for the 435 call. And if we integrated that, we would get a value of 415.58, which is the value of the stock. And that's if our model is a good model. This is how a stock looks to an efficient market. Now let me slow way down right there. Remember, I brought up the subject of efficient markets really early on, and I said we're not even going to talk about this until the end of the semester. So now it's time to talk some about efficient markets. This is what an efficient market amounts to in terms of at least our models. A market that is efficient has a distribution for a stock that looks like this if we're using a good model. So this distribution, if it is a well-modeled distribution, defines this effectively as an efficient market. Now we'll elaborate on that a little bit more. From this point on, when we see a stock, we don't think of the New York Stock Exchange, or we don't think of anything other than a distribution. We need to think in terms of just this distribution. That is the game we're playing. That is the world we're in. We're playing with nothing other than this distribution that defines the stock that we are using. Now, and it is an ideal because we are going to ignore kurtosis in this. Now, we don't ignore kurtosis in anything we do when we actually apply these models. We've been very careful to accept the reality of fat tails and how to deal with them and how you use models to get around the reality, how to in fact actually take advantage of them under certain circumstances. We're not glossing over anything by looking at this as an ideal. We know that when we get the imperfections as we move away from an ideal, we understand those and we know how to deal with them. So we're not oversimplifying anything here. We acknowledge that there is such a thing as fat tails. And if we were to try to do a Kolmogorov-Smirnov test on this, it wouldn't be perfect, of course, but it might tell us we have something akin to a 95% degree of fit. All right? So what we're looking at then is 7-day versus 1 day. And the reason I use the 1 day because that's how we think of the stock. What is its value right now at this moment? If you use the 7-day distribution, of course, with duration volatility, then you're actually asking a much more specific question, and that is, what do we expect this stock to be worth, or what is the range of its possible distribution over a period that is X long. In this case, that is a 7-day period. So if you take a look at this, how this differs, of course, in the way these mappings work, using pie plot, is in the abscissa being stretched out as the number of days goes up. You could also do this, it's kind of hard to do using a fixed abscissa, and that would be a little more indicative because you would have a narrower spread for the 1 day, obviously, than you would for the 7-day. But you understand what the difference is on this. And nonetheless, though, if we integrated either one of these, the 1 day, the 7-day, we're going to get an answer of 415.58. So again, no matter what it is we're looking at, its value is going to be in its entirety 4.158. And in the bottom case, duration volatility is equal to 0.1273, and that's why we get the wider spread that is actually represented by the stretched axes in this example. But I think by now we should all understand that completely. So if we're looking at this distribution as a stock, that is what we think of in our model as a stock. When we put this all in Python and we walk away from it and say, good luck with that, the only thing that the Python model knows about our stock is this. We've given it these key parameters, and this is what that model assumes about the reality of the object that it's trying to price and trade and track and so forth. That's what we're saying here. So how do we regard our stock if we write this option against it? So this is right back to the original mapping, and this is kind of an interesting approach to take. We have created two tranches in a distribution. So we started with something we call a stock, but when we create a strike price and a trading opportunity around it, we have created a minimum of two tranches, each of which has an individual value. We can in fact separate them and trade them. And when you trade a call or a put, that is all you're doing. You're taking a tranche of an established stock with a known or estimated distribution, and you are trading that tranche. That's certainly the case if you're using an algorithmic trading model to do it. The algorithmic trading model typically knows nothing more than that about the asset that you think you're trading. So what specifically are we doing this? Both of these tranches have a specific expected value, which can be estimated through integration or the equivalent of integration, just like the original standard normal we do, except as you can see right here, we're staying now within the log normal distribution. So each tranche, we can estimate the portion of the continuous or cumulative density function beneath the probability density function. And basically, if that tranche on the right with the yellow shading is an option of some kind, then the area of that yellow is going to be its value. And if this thing on the left, which is represented again as a slice of a probability density function for a stock, has value, it's going to be equal to the area underneath its probability density function. And so let's see what Spock would have to say about how this is to be valued. And Spock is going to say this. He doesn't care about what kind of theory you have about options trading. Spock says we're now in the world of the algo. We're now in the world of pure logic. If your tranche is priced efficiently, given market conditions, and you should assume that it is, unless you can find evidence to the contrary, and if this condition is typical of all tranches that you price, you have no reason to expect profits by virtue of trading these tranches. That's what Spock would say to you, because what makes you think that you would? If you have used a good model, and if you've used good estimators, then you have no reason to believe that buying or selling this is going to give you extra profits of any kind. Basically, if it's an efficient market or close to an efficient market, you'll be able to sell this for what it's worth, and that'll be about the same as its expected value. He might say, though, on the other hand, if you can find model-based evidence that this option is mispriced, even if momentarily, or perhaps because of a deficiency in someone else's model, then if you trade correctly with that information, profits become probable. That's what Spock would say to you. If, in other words, we have, even if we're assuming an efficient market, remember we started by saying, using the cobweb model as an example, that when there's a small shock, even let alone a big shock to this system, it takes a long time for a market to find a proper value at efficiency. Now, I traded options for a long time, and I have these models like this one right here tracking these options all the time. These markets under normal conditions are remarkably efficient. You can tell that traders out there are using models of various kinds, probably most of them using Black-Scholes, and if you take a look at a standard option chain on a standard day, they're being priced not too high or not too low. They're being priced about where your model says they should be. We actually saw that on the Netflix calls before they started to rise in anticipation of the earnings report. The near-term calls, their IDV was tracking short-term volatile historical volatility, but the more distant calls were tracking the more long-distance historical volatility, pretty much like the theory says they should. So this means, therefore, that there's no automatic trading that one can do that's just going to generate profits because you're doing it. You're going to have to find the source of profits if you're going to trade options, and that generally is true of just about everything. Remember, it does take time, though, for markets to get to these efficiencies, and we're seeing that in the stock market right now. We're addressing in these commentary slides that I'm doing, some of which I'm asking you to look at, where is this current stock market going? Well, this market is still going through a long search process before it settles down. It's currently rising slightly off of what appeared to be the bottom, and may actually turn out to be the bottom, but it is certainly doing it back and forth, trying to figure out ultimately what effect this pandemic is going to have. And as a result of that, the volatility in the stock market, as represented by the VIX, has been all over the place. That is a market looking for a solution. And when we have these massive shocks to the market like we had with the pandemic crisis, it takes a while for these markets to find that solution. Unfortunately, everything is so screwed up, it's kind of hard to trade in these markets without doing so at very high risk. But it's a great example of how markets can take time to find efficiency. One important qualification to everything we said here that Spock told us. Remember, we said that insurance hedge values in both futures and options can allow profits even in efficient markets. So if you're a speculator trading against someone who's looking for insurance through a hedge, then that person is allowed to and is willing to give you a premium on the trade for the purpose of setting the price and you taking the risk of price variance. That is logical within the constraints of the way this works, and Mr. Spock would approve of prices there being a little bit different than these models would introduce. But remember, when we were doing this with futures, we identified that these models can distort in this way pricing in insurance if they're net hedged long or net hedged short. I didn't explain that in terms of options, but it also holds in options just like it does in futures. Okay, let's ask some questions about these tranches. What are we looking at here again? We are looking at a call option. This is the call option that we considered buying, that our algo actually considered buying. That one's sitting right there, that algo considered buying on that morning and spit out some information to us, and we said, no, thumbs down, we're not going to do it. This is what we turned thumbs down on the call that we were considering. We also, of course, did the same for put because it was a paired trade as a strangle. So, is this call in any context inherently more valuable if we write it instead of buy it? That is, if you write options, can you simply write options all the time and expect to make money from it? Because that's what is often recommended on Reddit, for example. I see that all the time as a strategy. It's always okay to write options because you can make money if you write options. It's just you're harvesting the premium option. You hear arguments like that. Well, here's the answer. The answer is no. It's not inherently more valuable if we write it instead of buy it. Because looking at it in this context, why would you think it's inherently more valuable if we write it instead of if we buy it? This density distribution represents, based upon prior volatility, where the stock price might go, and this gives us an array that satisfies this segment that we call a tranche for our call option, and it is properly priced, unless something out there is disturbing it that we can identify. But it has a premium. Doesn't that matter that it has a premium? The answer is no. There's no reason to trade it or think it has any value or more value or value you can pocket just because it has a premium. Logically, you can see here, there's no reason to believe that. What is that? Well, what is that? Think about that for a second. This is actually an April 24, 435 put because it has the performance exactly of a put. And it is also worth its integration value. So basically what we're saying is you take a stock and split it right down the middle with a strike price. You may typically be interested on only one side, but on one side is your call, and on the other side is an equivalent put. Now, of course, it's going to be the case that the call is in the money and the put is not, perhaps, but that's the case here. But you still have effectively the other half of the tranche is mathematically it's a put. So when people say you should write options all the time, they're often talking about puts. Is this put inherently more valuable if we write it instead of buy it? And the answer, just like before, is no. If the market is pricing it efficiently, and most times the market does price it efficiently, then there's no reason to believe that this put has any inherent value by simply virtue of the fact that you write it instead of buy it. What if the IV rank is higher? And remember, I talked about that last time. What the brokerage houses do is they put the IV rank out because they don't compare it to historical volatility like, in my opinion, they should. They simply say this is the highest IV has been this year. So what they do is they rank where a stock's IV at that moment is compared to its distribution throughout the year, because the lower out there says that you write puts and you write calls when IV rank is high because they're big premiums, you're getting premiums. Complete nonsense for the largest part. If the IV rank merely reflects an increase in the volatility of the underlying stock, which is why the option has expanded its premium and why its measured IV is growing because of the volatility of the underlying stock, which should be reflected as a wider distribution in this context, then the answer is no. unless you have some reason to believe that the implied volatility of an option is rising while the stock itself is remaining as stable as before, only then would writing an option against that stock make sense. But simply by virtue of the fact, as is the case now, that options have high IV ranks compared to, say, a year ago or 6 months ago or even 3 months ago, that's, of course, because the stock market itself and the underlying securities represented by that market themselves are more volatile, and so therefore the risk is canceled out, or the gain from the risk is canceled out, one might say. So again, there's no reason a priori to believe that you have to, they should be trading this because IV rank is high. Today, for example, I was amused by this. Tesla had one of their sort of half-baked earnings reports yesterday. They gave no guidance, which you're supposed to give. Nonetheless, the Tesla fans, of course, all thought that because they made a small profit, they don't need guidance. And so in the aftermarket, they bid up the price of Tesla to almost $870 per share, up $100. When the market opened today, it plunged all day long and actually closed at about $750 per share, down about $120. That's what you call volatility. And so if you discover that Tesla's IV is high, that doesn't mean you should be writing puts and calls on Tesla because the stock itself is going through these extreme ranges. So how can we tell if an asset is mispriced? Because we are allowing for the fact that the markets are normally fairly efficient, but when the markets are going through a transition or they're recovering from a shock and similar, there's a period of time while they're seeking their new equilibrium and their new efficiency point, and you can trade during those periods. And also, you can find examples of stocks that for various reasons are actually mispriced according to your model. So now, before we get into this, though, I want you to understand, despite the approach we took here, where we're looking at the mappings, going right back to how we started, we're not suggesting that these mappings are used to find price anomalies. I'm going to give you the model to play with because it has the math built into it, but it's not a usable model. I use it for teaching, obviously. These are used here to illustrate the concept. And we do have to ask, though, when I showed you all this stuff, what was I using for volatility? Was I using implied volatility or was I using daily volatility? If so, what was the measure? Well, that's an important question. We went to a lot of trouble to develop various measures of historical volatility and good ways to measure comparative implied volatility. The implied volatility comes from the reverse solution of the model, when you have to iterate through the original model, whatever its structure, to get the sigma that is implicit in its solution. Historical volatility, of course, that we've been using, which is commonly used, is simply the log daily growth rate. Can you figure out a way to use these in combination to answer this question? That's the secret here in all of this. This is the question. Is this option being priced at an efficient price, where its expected value is equal to its price? Or do we have a trading profit opportunity here? Now, I'm going to leave that up to you to figure out the answer. With all of this background, you should be able to figure out the answer relatively easily, I think. You say, oh yeah, if we're comparing these two, if they don't match and we're doing the right comparison, then maybe sometimes I'll know when I am looking at a anomalous pricing example for whatever reason that's happening. That's one approach, and that I think is the most sound approach. That's really what we were doing when we were trying to price the Netflix strangle, although in unfairness to you, actually, that was an advanced strategy that relies upon kurtosis actually happening in a predictable way instead of an unpredictable way. But I think you saw enough of how we played around with the two different measures, historical and implied, to try to get that to settle down and figure out how these options behave during strangle opportunities. We used what we thought was the appropriate historical volatility for that trade, remember. We matched the shorter term option with the shorter term historical volatility, and we matched the longer term option with the longer term historical volatility. And that was not an academic example. That was a trade that we might actually have made had certain circumstances been different. That's why I like to use these examples, because we're not just using academic examples, we're actually using applied examples. Now there's some takeaway that we need to take a look that you need to take a look at, that you must try to understand here. And so this can be the basis for the bulk of your study for at least this lecture. For the last quiz we're going to have, and I'm going to give you an audio file about that quiz also, and a little more guidance on preparing for it. I'm not going to go down deep into those strangle trades, just superficially. The key takeaways there will give you some clues. An option can be thought of as a portion of a log normal density distribution with measurable and understandable properties. An option can be thought of as a tranche taken from that distribution. If it is a call, the other portion of the tranche is a put at the same strike, or there exists at least a put at the same strike with its own properties. And if the call is in the money, the put is out of the money. Markets do tend to efficiency through arbitrage, mostly, although as external events change, it takes time to get to efficiency. Uncertainty causes a disturbance to efficiency, and sometimes that may provide opportunities to trade. This is the takeaway you really have to have if you're going to trade professionally. There is no inherent logical reason to believe that writing puts or calls is profitable or more profitable than buying them just because options have a premium. Options in a perfectly efficient market will have a premium. Of course, we just looked at that. And options in an imperfect market that are nonetheless money losers if you write them will also have premiums. For example, what if the actual option is priced below what our model says they should be at? They'll still have a premium, and so does that mean you would make a profit in writing them? No. If they're priced below what our model says they should be at, you'll make a loss on that if our model is any good. So the fact that it has a premium, you're harvesting premiums, all just largely nonsense. One model-based way to evaluate transitional or anomalous options is to tediously compare appropriate measures of the volatility of the underlying to appropriate measures of IV. Of course, you need one of these things to do that, which is why in this class we've worked a little bit on trying to accomplish that goal. But don't forget kurtosis and poor fit. We realize that, of course, these models are not perfect. We might be misusing them. Kurtosis we know exists. We don't even bother to test for it because we know it's there when you're talking about stocks. But again, we have a very healthy attitude about how to react to kurtosis, and our model isn't much crippled by the reality of it being there, because in our mind, as we set these trades up, we know that it's there, and sometimes we might even try to trade it or benefit from it. Now, after all of this, if you listen to the horse race example story, you should understand that now we are still talking about the horse racing model. See, these models will simply estimate values. They'll estimate probabilities just like the horse racing model did. They'll be error prone. They have to deal with things like kurtosis and poor fit. But on the other hand, everybody else is trying to do the same thing. And if you're good and you're smart and your model is well designed, then in that game you have an edge over people who aren't doing it quite as well as you're doing. That has always been the way these models work. And so that's why, to some extent, so long as you grasp that trading philosophy about this and never forget the math of what you're doing, don't over-respect it, but you're mutters, you know how to regard math models and the like. You know their limitations, but you also know their power when they're used properly. Then this can be a very strong tool. And even though the lecture segment that you will be graded on ends with this lecture. I still plan to pump out the videos all through the summer to complement all of this. In fact, the next one coming up is on options trading for credit spreads. And those are very commonly used. If you decide you do want to write calls and puts because you find that they're priced the way they're priced, then maybe you want to use credit spreads to do that so you won't have nearly unlimited liability. Well, that's enough. That was a long presentation. I want you to think about what we said here, and we'll be talking to you soon, if you see this in the next few hours or the next day, on a audio email where I give you some instructions for getting through the rest of this rather strange semester. So long.